Investing for children is a thoughtful and a generous way to create future opportunities for them. It's more than just saving money, it involves careful planning and understanding how the finances and laws work. By starting early, you can benefit from compound growth where even small investments can grow into large amounts over time. So this money can help pay for your child's education, first home, or other important milestones. So this approach not only provides financial security but also teaches your children important lessons about managing money and also planning for the future. I recently came across a fascinating article on MoneyWeb about investing for your children's future, and I knew that I had to share it with you by giving you a summary of it. So you can find the link of the article in the description below for a more detailed read. And guys, please note that I'm not a financial advisor. If you're seeking for any financial advice or a financial advisor, then please be sure to look for someone who is certified and also is registered with the FSCA. So guys, don't forget to like this video and subscribe to the channel for more financial tips. So the article explored legal responsibilities for parents and guardians, the various investment options available, and the tax implications associated with investing for your children. So by equipping yourself with this knowledge, you are able to make informed decisions that will benefit you and your child's future. According to the Children's Act, a child is defined as anyone under the age of 18. So as a parent or a guardian, you have the legal duty to manage and protect your child's property and property interests, and to assist or represent them in contractual and legal matters. And under common law, children under 7 years old cannot make legal decisions or act independently. So those aged 7 to 18 have limited capacity to act, meaning that they can enter into contracts only with their parent or a guardian's consent and assistance. But with that being said, there are two key exceptions to this rule where a minor can enter into a binding contract without a parent or a guardian's help. The first one is legislation prescribes another age. So for instance, the Wills Act allows minors aged 16 and older to execute a will and those aged 14 and older to witness a will. Number two is contracts imposing rights but not obligations. So for example, a minor can accept a beneficiary nomination or a donation without needing a parent or a guardian's approval. In practical terms, this means a child cannot open or manage an investment account on their own. All necessary forms must be signed by a parent or a guardian. And additionally, no one else can open an investment account in a child's name without the parent or guardian's consent. So let's say if a child has two parents or guardians, either one can manage the investment account independently without needing the other's permission. So for example, if you want to set up an investment account for your 10-year-old child, you need to sign all the documents yourself. So similarly, if a 15-year-old receives a donation, they can accept it without any additional consent. But however, guys, they will still need your assistance to open an investment account with that donation. So guys, let's first look at the investment options that are available for children. So children have an opportunity to invest in a variety of financial products, but it's crucial to weigh the pros and cons of each option. What may be beneficial for an adult investor could be unsuitable for a child. For instance, tax advantage for adults might not apply to children who do not have an income. So with that being said, here are some common investment vehicles along with the advantages and disadvantages. So number one is unit trust. So advantages for unit trust is that they are flexible and accessible at any time. And the disadvantage is that they may have tax implications that are unfavorable for children. So investment option number two is tax-free investment. So the advantage for this one is that the growth is tax-free, making it an attractive option for long-term savings. And the disadvantage when it comes to this one is that there's limited contributions that can be made each year. Investment option number three is retirement annuity. So let me start with the advantages. The advantage for this one is that there's tax-free growth and the ability to accumulate non-deductible contributions for use at retirement. But the disadvantage for this one is that there's restricted access until retirement age and must adhere to a legislated asset allocation framework. Number four is endowment. So an advantage for this one is that there's restricted access that helps ensure that the investment is used for intended purposes. And disadvantages for this one is that they can have tax implications that may not benefit a child. So by considering these options carefully, you can choose the best investment products for your child's future. So now let's talk about the tax implications associated with investing for your child. So parents can gift or donate up to 100,000 rands each tax year without incurring any tax liabilities. However, if the total donated exceeds this amount, donation tax kicks in at the rate of 20% on the portion under 30 million and 25% on any amount above that threshold. So it's essential to actually note that this donation limit applies to each individual donor per year rather than to the recipients. So if you and your spouse both donate to a child, each can actually give up, let's say, 100,000 without triggering tax. So if you decide to gift your child some money for investments, keep in mind that any income or capital gains from those investments will be taxed under your name while your child is still a minor. So for example, if you donate 50,000 rands for your child to invest in a stock that generates dividends, those dividends will be included in your tax return, not your child. Now, when it comes to gifts from other relatives like grandparents, the tax situation shifts. So if your child receives an inheritance or a monetary gift from someone other than their parents, such as the grandparents, they will be responsible for any taxes on the income generated from that gift. So for instance, if a grandparent gives your child 70,000 rands and it generates interest or dividends, it's your child's responsibility to actually report an income on their tax return. So if their taxable income reaches the threshold for taxation, you will need to register them for income tax and file a return on their behalf. So this understanding can help you navigate the complexities of financial gifting and tax obligations effectively. So now, what happens when your child turns 18? When a child turns 18 in South Africa, they officially step into adulthood and gain full control over the investments held in their name. So this milestone also means that the parents lose their right to make transitions on those investments. So to maintain control over the investments, parents need to either withdraw the funds completely or transfer them into their own name before the child's 18th birthday. But however, keep in mind that depending on the investment performance, this could trigger capital gains and tax on the profit made from selling investments. If your newly adult child wants you to keep managing their investments, they will need to give the investment manager written permission for you to act on their behalf. On the other hand, if your child prefers to handle their finances independently, they simply need to submit any necessary documents to the investment manager. So once they turn 18, you're off the hook for any income and capital gains from those investments. Your child will now take on the responsibility for filing their own tax returns, marking a significant step into their journey towards financial independence. So this transition is a great opportunity for them to actually learn about managing their money and also understanding their tax system at first hand. So now, how do you protect young adults from themselves? While we can do our best to teach our children about money and the benefits of compounding growth, it's not unusual for young adults to actually make unwise financial decisions. For instance, they might spend their hard-earned savings on the latest gadgets or luxury items instead of saving for important goals like college or a first home. So if you are worried about your child mismanaging the investments you have worked hard to build for their future, you might want to think about setting up a separate account in your name or creating an inter vivos trust to hold their investments. So in this way, you can actually retain control and ensure that the funds are used wisely when the time is right. So in conclusion, investing for your children is a powerful way to actually secure their financial future and open doors to opportunities that might otherwise be beyond their reach. So by familiarizing yourself with the legal frameworks, various investment options, and also tax implications, you can make choices that are truly aligning with your family's needs. So for example, investing in a tax advantage education account can help cover your child's education expenses, while a custodial account can introduce them to investing early on. So as your child matures into adulthood, it's very essential to actually adapt your strategy and ensure a smooth transition of financial responsibility. So teach them about budgeting, saving, and also investing, which can empower them to actually make smart financial decisions or choices. So also consider protective measures such as establishing a trust to actually further enhance their financial security. So this not only just safeguards their assets but also allows for greater control of how and when they can actually receive the funds. So by taking these thoughtful steps, you're not just only putting money away, you're actually investing it for your child's future success and stability, setting them up for a life filled with possibilities. So if you enjoyed this video as a parent, you'll definitely enjoy these other videos here where I talk about how to create a trust and also set up a will. So go ahead and click on them and I'll see you in these videos.